Your credit score is a crucial aspect of your financial health, influencing everything from loan approvals to interest rates and even job opportunities. However, many people unknowingly engage in habits that can severely damage their credit score over time. Whether it's missing payments, maxing out credit cards, or neglecting to monitor your credit report, these seemingly small mistakes can add up, leading to a lower score and financial difficulties down the road. Understanding and avoiding these harmful habits is essential to maintaining a strong credit profile and ensuring long-term financial stability. Here are 10 habits to watch out for. Late payments can significantly damage your credit score, often serving as a red flag for lenders. Even a single missed payment can remain on your credit report for up to 7 years, dragging down your score and making it harder to secure loans or favorable interest rates. Consistently paying bills after their due dates signals financial irresponsibility and unreliability to creditors. This habit not only affects your credit score but can also lead to hefty late fees, increased interest rates, and potential account closures. To avoid this, set up automatic payments or reminders, prioritize bills, and communicate with creditors if you're facing temporary financial difficulties. Remember, your payment history is the most crucial factor in determining your credit score, so staying on top of due dates is essential for maintaining good credit health. Maxing out credit cards is a detrimental habit that can severely impact your credit score. When you consistently use most or all of your available credit, it increases your credit utilization ratio, a key factor in credit scoring. High utilization suggests financial strain and can make you appear risky to lenders. It also reduces your financial flexibility, leaving you vulnerable to unexpected expenses. Moreover, carrying high balances often leads to paying more in interest, making it harder to break the cycle of debt. To avoid this, aim to keep your credit utilization below 30% of your available credit. Consider spreading expenses across multiple cards or requesting credit limit increases. Remember, responsible credit use demonstrates financial stability and helps maintain a healthy credit score. Ignoring bills in collections is a serious mistake that can devastate your credit score. When accounts are sent to collections, they're reported to credit bureaus, creating long-lasting negative marks on your credit report. These entries can remain for up to 7 years, significantly lowering your score and making it challenging to obtain new credit or favorable terms. Collections also signal to potential lenders that you've failed to honor financial obligations, damaging your creditworthiness. Instead of avoiding collectors, it's crucial to address the debt promptly. Negotiate a payment plan or settlement, and always get agreements in writing. Once resolved, request the collection agency to update your credit report. Remember, proactively dealing with collections can mitigate damage and set you on a path to rebuilding your credit. Applying for too much credit in a short period can significantly harm your credit score. Each time you apply for credit, a hard inquiry is recorded on your credit report. Multiple hard inquiries in quick succession can signal financial distress to lenders, suggesting you're desperately seeking credit. This behavior can lower your credit score and make you appear risky to potential creditors. Additionally, opening several new credit accounts reduces the average age of your credit history, another factor in credit scoring. To avoid this, only apply for credit when necessary and space out applications over time. Before applying, research your likelihood of approval to minimize unnecessary inquiries. Remember, responsible credit management involves thoughtful and strategic applications, not frequent attempts to secure new lines of credit. Closing old credit accounts, especially those with a long history of good standing, can unexpectedly harm your credit score. This habit impacts two crucial factors in credit scoring: credit utilization ratio and length of credit history. When you close an account, you reduce your overall available credit, potentially increasing your utilization ratio if you carry balances on other cards. Additionally, closing long-standing accounts can shorten your credit history, which accounts for about 15% of your FICO score. Lenders value long-term relationships as they demonstrate reliability over time. Instead of closing old accounts, consider keeping them open with minimal activity. If you must close an account, prioritize newer ones or those with annual fees. Remember, a longer credit history generally contributes positively to your credit score. Only paying the minimum on credit card balances is a habit that can significantly damage your credit score over time. While it keeps your account current, it leads to higher credit utilization ratios, a key factor in credit scoring. Carrying high balances month to month signals financial strain to lenders. Moreover, this practice results in accumulating interest, making it harder to pay down the principal and potentially trapping you in a cycle of debt. High balances relative to credit limits negatively impact your score, even if you're making timely minimum payments. To improve your credit health, aim to pay more than the minimum whenever possible, ideally paying the full balance each month. This habit helps reduce your credit utilization, saves money on interest, and demonstrates responsible credit management to potential lenders. Countersigning loans recklessly can severely impact your credit score, often in ways you might not anticipate. When you co-sign, you become equally responsible for the debt, and it appears on your credit report. If the primary borrower misses payments or defaults, your credit score will suffer just as much as theirs. This can lead to unexpected drops in your score, potentially affecting your own ability to secure credit in the future. Moreover, the additional debt impacts your debt-to-income ratio, which lenders consider when evaluating loan applications. Before co-signing, carefully consider the risks and ensure you can afford to take on the debt if necessary. Remember, helping someone establish credit shouldn't come at the cost of your own financial health. Neglecting to review your credit report regularly is a harmful habit that can silently erode your credit score. Your report may contain errors, fraudulent accounts, or outdated information that negatively impact your score without your knowledge. Identity theft or mistakes in reporting can go unnoticed for months or even years, causing significant damage to your creditworthiness. By not reviewing your report, you miss opportunities to dispute inaccuracies, identify areas for improvement, or detect potential fraud early. Federal law entitles you to one free credit report from each major bureau annually. Make it a habit to review these reports regularly, ideally every 4 months. Staying informed about your credit status allows you to take prompt action to maintain or improve your score. Not having a mix of credit types can subtly harm your credit score, as credit diversity accounts for about 10% of your FICO score. Lenders prefer to see that you can manage various types of credit responsibly, including revolving credit, like credit cards, and installment loans, such as mortgages, auto loans, or personal loans. A limited credit mix may suggest inexperience in handling different financial obligations, potentially making you appear riskier to lenders. While it's not advisable to take on unnecessary debt solely to diversify your credit, consider strategically incorporating different types of credit over time as your financial needs evolve. This approach can demonstrate your ability to manage various credit accounts responsibly, potentially boosting your overall creditworthiness and improving your credit score. Settling for high interest rates can be a costly mistake that harms your credit score over time. When you accept higher interest rates on credit cards, loans, or other forms of credit, you end up paying more in interest, which can lead to larger balances and increased financial strain. This, in turn, makes it harder to keep up with payments, increasing the risk of missed payments or growing debt. Additionally, Carrying high-interest debt can negatively impact your credit utilization ratio, a key factor in determining your credit score. Shopping around for better rates and negotiating terms is essential to protect your credit. Thanks for watching the video. Please subscribe.